Hello, everyone, and welcome back to Collin Investing. Today, we're diving deep into the U.S. stock market, analyzing recent trends, and unpacking some critical predictions. We'll examine fresh economic data, political maneuvers, and key company updates to help you understand where the market might be heading. Consider a situation where economic indicators show mixed signals, and political tensions add layers of uncertainty. Let's navigate this intricate landscape together. We've set the stage with an overview of the current market complexities. Now, let's dive into some concrete numbers, starting with the latest retail sales data. The headline figure for February shows a 0.2% increase, which falls short of the anticipated 0.6%, and it gets more interesting. January's numbers were revised downwards quite significantly to a negative 1.2%. If we take out the auto sector, core retail sales only grew by 0.3%, again below what was expected. However, here is the twist. The control group, those sales that directly feed into GDP calculations, actually surged by 1%. So we have clear conflicting data in the retail sales. It makes it very complex to invest, right? So the overall retail picture is frankly all over the place. But let's break it down by sector to see what's really happening. We're seeing growth in areas like online retail, no surprise there, as well as health and personal care and food and beverage. People are still prioritizing the essentials. However, and this is a big however, restaurant and bar sales took a noticeable hit, dropping 1.5%. That's often a red flag, suggesting consumers are cutting back on discretionary spending. Gas stations and auto parts also saw declines. We all see this push and pull, right? It points to consumer pressure, definitely, but not a complete collapse. Some areas are holding up while others are showing signs of strain. These numbers paint a confusing picture, but there are a few key takeaways. Some analysts argue that we shouldn't jump to conclusions about weak consumer demand. They point to external factors like unusual weather patterns, the leap year's extra day throwing off comparisons, and even delayed tax refunds as potential culprits for the lower than expected retail sales. It is important to notice that the consumer confidence is low, yet people are still spending. What about the reality? Well, Bank of America's consumer survey adds another layer, showing overall card spending down year over year, but if you adjust for that leap year, it is actually slightly. We can see a little bit complex situation, right? Building on the mixed signals from the retail data, let's dive into Bank of America's consumer survey for more clarity. The key takeaway: high-income households are truly driving consumption. We saw that their post-tax income jumped 3.5% in February. Also, a rising stock market is adding to their wealth, fueling more spending. And while restaurant spending dipped, as we noted earlier, overall service spending is still on the rise. So what does all this mean? The big picture is that the consumer engine, particularly at the higher end, remains pretty strong. While high-income earners are leading the charge, what about everyone else? Well, Bank of America's data breaks it down, and it's a bit of a mixed bag. Spending by high and middle-income consumers is tracking pretty closely, but low-income consumers are definitely feeling the squeeze. With spending growth at only 1.3%, it is significantly lower. However, and this is important, even those low-income households generally still have more in savings than they did before the pandemic, even after adjusting for inflation. So here is a bit of a cushion there, even at the lower end. So we've seen the consumer data, right? High-income spending is strong, and even low-income households have a bit of a cushion. But what about the bigger picture? The dreaded word, recession. Well, here is a clear disconnect. The actual consumer data, what people are doing, clashes with the market's expectations. What people are fearing: the economy is showing resilience. I am not telling it is a party. We might see a slowdown, sure, but a sudden dramatic collapse, it doesn't seem likely based on the numbers. It really looks like the market pricing might be reflecting too much fear, an overreaction to recession risks. We have just discussed how resilient is the U.S. economy and the potential space for market increase. However, there is also space to decrease. Let's turn our attention to another crucial indicator, the New York Fed's manufacturing index. And the news here isn't good. The March index plummeted to -20. It is a shocking drop from 5.7 in the previous month. This is a collapse. New orders and shipments, they are critical components, also saw sharp declines. What's more, the index looking at future business conditions also fell. This signals a significant drop in optimism among manufacturers. This is something that contrasts with the previous data. However, we must consider it. We've looked at the manufacturing sector's woes, and it is very important. But it is also crucial to consider external factors. let's shift gears to the political arena and its impact on the market. Specifically, let's talk about Trump's tariff policies. He's still pushing hard for tariffs, and that's undeniably creating economic uncertainty. However, and this is interesting, the markets aren't panicking. There hasn't been massive sell-off, suggesting a degree of immunity, or perhaps that this is already priced in. Circle the 2nd of April on your calendars. That's the planned date for reciprocal tariffs and additional tariffs on industries like auto, steel, and aluminum. This could be a major market mover, or not. We will see. We've talked about the looming threat of tariffs, specifically the 2nd of April deadline. But here's a potential twist. Reports are surfacing that the U.S. Trade Office might be considering a more measured approach. Imagine that instead of a sudden shock, new tariffs could be phased in gradually. The idea is that they would seek input from businesses first, which can give a different perspective. Now, you might be wondering why the change? Well, it could be a strategic move to calm market jitters, provide a little bit of certainty, and give companies time to adjust their supply chains. It would be much better, right? We've considered the potential tariff mitigation, and that brings us to a critical question. Is a market rebound on the horizon? Fidelity's analysis offers a compelling point. When bad news, like the tariff announcements, doesn't cause the market to sink to new lows, it often signals that a short-term rally is brewing. Think of it like a coiled spring. Besides, history tells us that February and March are often weak months for stocks, almost like a seasonal dip. But April, historically, it's a strong performer. So we have seasonality on our side. Morgan Stanley, however, injects a dose of caution. They see a technical rebound happening basically, the market bouncing back from being oversold. But, and this is a big but, they believe that for sustained long-term gains, we need significant policy shifts, like tax cuts, deregulation, and the Fed easing up on interest rates. Let's take the market pulse. What are the indicators telling us? Interestingly, the Dow Jones and small-cap stocks actually outperformed the broader S&P 500. That's a clue. It suggests investors are feeling less anxious about those tariff threats and the overall health of the economy. We can confirm it with the performance of the industrial and material sectors, which are very sensitive to tariffs. Also did surprisingly well. It is a solid clue of a good moment. So the market could be poised for a rebound. But what are the big players, the institutions, doing? Well, they're surprisingly quiet. Deutsche Bank reports that overall stock market positioning is at an asterisk 16-month low. It's incredibly low. JP Morgan chimes in, saying tactical positioning, that short-term stuff is near historical lows. This means light equity exposure. They're not holding much. And Goldman Sachs, they're seeing the same thing. Multi-strategy funds have incredibly low net exposure. All of this cautious stance, it actually supports us. The idea of a potential rebound, if everyone's already on the sidelines, here's more room for them to jump back in, right? So, institutional positioning paints a potentially bullish picture. But what could derail a continued rebound? Two major threats are looming. First, a significant worsening of economic data, and second, a hawkish Federal Reserve, meaning they stick to higher interest rates for longer. However, based on what we have discussed, the first threat seems less likely. The recent data, the current data, suggests the economy is not as weak as the market initially priced. All eyes are now on the Fed meeting this week. The expectation. They will hold rates steady, however, we need to focus on the dot plot. That's their projections for future interest rates. And pay attention to any discussions about slowing down quantitative tightening or too tight that could inject more liquidity into the market. So, we have checked many factors for the market rebound now. It is the moment to switch gears and talk about a specific company that's generating a lot of buzz. Nvidia. This week, all eyes are on Nvidia's GTC conference, and it is not just another tech event, I am telling you. It's a major happening for anyone invested or interested in AI. The main attractions. First, CEO Jensen Huang's keynote speech. Expect fireworks. Second, the analyst Q&A, where we can have details. The market is hungry for updates, specific updates. Think of it as, on Nvidia's product roadmap, especially the new Blackwell Ultra and Rubin chips, how they'll be used in data centers, and very important, when Nvidia expects its profit margins to recover, it is the moment for the truth. We've been focusing on Nvidia's strategic moves. But what about its stock performance? Well, it's been a bit of a roller coaster. The stock opened high but closed low and on reduced volume. What does it mean? It is a bearish signal. To add to the intrigue, Nvidia significantly underperformed compared to other semiconductor stocks. The options market is also hinting at some big price swings ahead, potentially around $7 up or down from the $120 mark by week's end. It means Nvidia can reach 127 or 113. We will see. We just saw Nvidia's stock performance, a bit shaky. Now, let's zoom in on the technical analysis, and it gets a little concerning for short-term bulls. Basically, Nvidia needs to act fast if it wants to keep any upward momentum going. The problem, those long-term moving averages, they're not looking good. We're on the verge of what's called a death cross. The 50-day moving average could drop below the 200-day. We do not want to see it. For those hoping for a rally, the magic number to watch is $125. A breakout above that level is absolutely needed to create some real upward thrust. We've been talking a lot about Nvidia, but what about the rest of the semiconductor space? Here is where it gets really interesting. Most other chip stocks actually rallied, and they did it independently of Nvidia. This divergence, this split, is a big deal. We can consider that it suggests a shift. We could be moving away from Nvidia's total dominance in the AI chip market, it seems. Funds are starting to diversify, spreading their bets across other players. A good and clear example is AMD. They had a strong day, high trading volume, and get this, they actually outperformed Nvidia. It's a significant shift in the landscape. We just saw how it was going the semiconductor environment. So let's continue with another big player. Intel. INTC has been on a bit of a roll, continuing its climb after breaking through that $23.7 resistance level we've been watching. Right now, it's trading in the $24.4 to $26.5 range. There are some news. The new CEO is talking about a major shakeup, overhauling chip design and manufacturing. It sounds exciting, but I have to say it, the short-term fundamentals are, to be direct, weak, really weak. Most of the trading right now is riding on speculation and news, not solid financials. So, trade carefully. We are talking about speculations here. Let's continue our journey into the semiconductor world. We've touched on Intel's speculative rally now. Let's examine ASML holding. We saw a slight, and I mean slight, volume increase today. But the real story here is the $734 level. That's key support. If, and only if, ASML breaks above that, we can confidently say it's found a bottom. So let's talk strategy. Long term, I'm talking about years. ASML is, in my opinion, a solid investment. But 2025 this year might be bumpy due to some internal business adjustments. But wait for it. 2026 is projected to bring much stronger growth. Keep an eye from ASML. Let's move to a stock that's had a rougher day. Tesla. The electric vehicle maker's shares dropped. It fell almost 5%. It is a bad day. There are some videos that impacted negatively. I will not comment, but I can say from a technical standpoint, any chance of a breakout before this week's options expire. Forget it. Very unlikely I would tell you to do something. But, honestly, there are no clear trading opportunities, short-term or long-term. My advice? We have to wait. We just checked Tesla's situation, and unfortunately, Affirm is also having a tough day. The buy now, pay later company. It initially plunged 15%, but thankfully recovered most of the ground, ending down around 4%. So, what happened? Bad news. A Swedish competitor is swooping in to become Walmart's exclusive buy now, pay later provider. Basically, Affirm got replaced, so let's go to the technical analysis to show any signs of life. Affirm needs to break above $52.6. Watch $42. That's support. But the key level, the one to really watch, is $36.5. We just checked Affirm's situation, and let's finish with a quick look at Berkshire Hathaway. Warren Buffett, the Oracle of Omaha himself, is making moves, and it is very interesting. He's increasing his stake in 5 Japanese trading companies. He is still investing outside the US. It is a clear signal, right? It suggests he sees better returns, or maybe lower risks, overseas. Now about Berkshire's stock. Many consider it a safe haven because of Buffett's famously cautious approach. However, a word of warning, its current valuation is pretty high. Be careful. So, we've covered a lot of ground today, from mixed economic signals to political maneuvers and company-specific updates. What are the key takeaways? The U.S. economic picture is undeniably complex. We have conflicting data, growth in some areas, weakness in others. It's a real puzzle. But, and this is crucial, market sentiment might be too pessimistic. This opens the door for potential short-term rallies. As we discussed, however, let's not forget the risks, and they are very real. Trump's tariff policies. I am talking about the 2nd of April and the Fed's upcoming decisions. They are major wildcards. Finally, keep a close eye on Nvidia's GTC conference and the flood of earnings reports coming our way. There'll be major catalysts shaping market direction in the near future. I really expect important changes in the next weeks. And that wraps up our deep dive into the current market complexities. I hope you found this analysis useful. Remember to stay ahead in this ever-changing financial landscape, so hit that like button and subscribe to Collin Investing. We really need your support also. Please share this video with anyone who's passionate about finance and investment. I will be reading your comments and I am really interested about your opinion. Got thoughts, questions, or predictions of your own? Drop them in the comments below. Let's continue the conversation. Let's keep the discussion going. Your engagement. We really appreciate it.